Hey everyone, so we're going to finish off Nelnet today. We're going to finally do the valuation. I'll give you my opinion at the end as well. I hope you're finding this one interesting. Now, regarding brokers, if you're looking for one, Interactive Brokers is the one that I use. Link in the description as always. Please check that out. Please check out the demo videos I have here on the channel to show you how to use it if you're interested. Great platform. It's the one I use. All right, let's jump into the valuation for Nelnet. And we're going to do it in two different ways. First, we're going to look at a sum of the parts kind of style. I know that's a little bit boring, and we'll then do like an earnings based approach a little later as well. I think that will give us a pretty good feel. So some of the numbers will come up on the screen here. Let me go through them. So the melting ice cube has about $1.5 billion left to receive over the next 10 to 12 years. Let's call that $1 billion of value. Then there's the student loan servicing business that generates about 60 to 100 million in operating income per year. As long as students need to get loans from the government, Nelnet should keep this train going. This doesn't grow much. It's a bit up and down. Overall, it's pretty stable. I think it's probably worth about maybe 250, 300, 350 mil, somewhere around that number as a separate business on its own, as it is concentrated in one particular customer, that being the government, but that you can have contracts with the government in place for 5-10 years. So paying potentially 4-5 times the operating income, I think is totally fair. Especially if you can lock in a contract for that period of time, it's worth about 300 mil, maybe more. Now, the education software and services business, the business segments here do about 400 million in revenue and 74 million in income, and it's growing at about 13% per annum. The retention rates, like I've said before, about 98%. That's incredible. So I'm going to value this business as a standalone business at $1.2 billion. I got to that by using the income of 74 million, multiplying it by a reasonable multiple, I think 18, for a very high margin software business growing at 13% with exceptionally low churn rates. I think this is extremely valuable. 18 might be conservative, but let's say it's 18x on the 74 million. So we're at 1.2 billion. Then we look at renewables and other. This was hard to figure out as they have spent about 2 billion on this over the last 10 years. Considering they have a 15% return on investment hurdle rate, the likelihood that this is still worth at least what they've spent on it. So I think we're going to put this number at 2 billion, but I think this is going to generate a lot more earnings in the future. It's still in the early stages of that 40-year runway. Then we're looking at Allo. So the 40% stake in a 2020 valuation would have put this at 200 million. It's grown a lot since then, but let's assume its valuation still at that 40% stake is still about 200 million. Otherwise, it'd be guessing. So I'm going to just go on the 2020 valuation of 200 million. Nelnet Bank, the next segment. I have no idea what this is worth. This is pretty early in its life. It's started in 2020. It is profitable, and I hope they're making loans responsibly, but it's just too early to tell. I'm going to just call this nothing because I don't know how to value that one, and it's too small anyway. I'm not going to worry too much. Next, which I find pretty interesting, is the HODDER investment. They've got a 20% stake in this. It's a really high margin business. I didn't know how to do this, so what I've taken was Arch Capital from that Chit Chat Money podcast episode where I learned a lot about this business. I think they did some really good guesswork here, and I'm going to steal some of their ideas. They think the HODDER is probably worth somewhere around 2 billion today based on the high margins and their average revenue per user and how many users they have and all that math. So if it's $2 billion and they have 20% of that, it's probably worth about 400 million today in today's market. So overall, if we add all of those up, we're at somewhere around 5 billion. And growing at hopefully 15%, which it's historically been growing at 17% overall, this business. But even if it's growing at, say, 15%, that's pretty cool on that 5 billion. I think that's something that can last for a long, long time as well. But at a 3.3 billion market cap currently, we get the growth in book value at 15% per annum on that 5 billion. But we also get the potential book value to be closer to a fair realized value of like price to book value of 1. And that would then indicate that we're not just going to get our 15% per annum, we're going to get closer to 20% as that gap closes between the hidden value and the current value. And remember, that was because Nelnet don't need to write up the book value to the current market prices in the financials. They only need to say what it was last valued at in some of their assets. And some of those things haven't been valued at for a long time, like the Huddle stake, which was valued last in 2020. So if you look at the price to book on Yahoo Finance or TIKR, you're going to see that the price is somewhere around, like the price to book is somewhere around 1. But I don't think that's true. I think it's more like 0.6, 0.7, something like that, because I think it's the book value is closer to 5 billion, maybe even more. Now, it's not illegal what they're doing, how their book value is stated. It's just the gap rules that they have to follow. So then I thought a better way to potentially value this business was to look at the way Arch Capital did it. And they talked about like the earnings power of the overall business. And I think that makes more sense to me anyway. These are going to be their numbers, not mine. They think that about $2 billion will be available to redeploy over the next 5 years at the head office, which is hopefully going to be all reinvested. So assuming we're going to flatline that out over 5 years, calling that 400 million a year. So with the current market cap, we're looking at about 8 times operating cash flow valuation. So 400 million times 7, 8, something like that to get us the market cap. For a business that's run really well, it's diversified, it's got many areas to reinvest and historically grown at 17%. We're paying an 8 times multiple on that. That's a pretty attractive price. Now, I know there's a scenario where I've been too conservative here, and there's a scenario where I haven't been conservative enough and macro factors interfere and I'm wrong and who knows. So what I tried to work out next was a risk adjusted return of this. So here are the numbers on the screen and what I used. Let me explain each one. So what I've done is I've got maybe there's a 1% chance that I'm completely wrong. This is a complete mess. They're fraudulent. They get sued. They have to close up shop. This whole thing goes to zero. Unlikely, but let's call it a 1% chance. We have to factor in that there is a chance of this happening. Let's then say there's a 9% chance it misses really badly on their targets. Some segments get into some trouble. The government interferes with 1 or 2 of their segments, things like that. Let's say there's a 9% chance of that happening, and in 5 years' time, other segments grow, other segments decline. We essentially end up where we are at the moment. So that's a 1x return on our investment over 5 years. Then I think there's a 60% chance, the most likely outcome, that I'm kind of in the ballpark, but the price to book value doesn't re-rate to my book value expectations. It just stays at around about the same book price to book value that you see on TIKR, but we're still going to get sort of 15% growth per annum moving forward. That would still give us a double from the current share price. I think that's the most likely scenario. Then there's obviously the upside, which is the 30% chance that I am too conservative, that they grow at least 15% plus per annum. And there's the closing of that discount to a fair book value. So there's that multiple expansion as well. So we're looking at a 3x over the next 5 years. And I think there's a 30% chance of that happening. I think that's quite likely, more likely that it just stays the kind of in the same ballpark. But I think there's a pretty good chance that that happens as well. So looking at that, I've got a risk adjusted return of 2.19x over a 5-year period. And that's a really strong number. Anything over 2x is good. So that's one of the higher ones that I've looked at recently. All right, so let me jump into a summary now of everything we've covered in the previous 4 videos. I'm going to try to put it down into the things that I like. Let's start with that. So the things that I like are that I really like the management. I like their history. I like their thinking. I feel really confident with the management team on this one. I like the long runway to reinvest into many different areas for growth. And there's lots of spawning going on here with different things coming up all the time. They really seem to be on top of capital allocation. They've got a really long-term thinking mindset. That delayed gratification of some of their projects I think is really cool. Very rare to see, but I think it's cool. They've got strong book value per share growth over many different cycles now. We're looking at nearly 20 years and it's been consistent along the way, which is cool. I think they're great owner operators and the price looks attractive. So there's a lot to like about this one. Now let's flip that around and talk about the things that I don't like. So some of their businesses are in competitive spaces. I don't like that as much. A few businesses can be changed by government interference as well. And I also don't know if they are making bad loans that we won't see until later on with that Nelnet bank. There's a bit of a black box situation going on here, and you're going to have some levels of trust on this one. I'm definitely not putting my whole portfolio in this one because there is a chance that something is wrong under the hood here, but the track record suggests that that's pretty unlikely. The other thing I don't like is the annual reports are massive. Like they're huge. They're well over 200 pages. Like they took me forever to get through and I got bored and I didn't probably read it thoroughly. Their annual reports are massive. So that's a negative for me because it just took so long and I probably forgot most of the things I read anyway. So does this one go on my watch list? Now, I think this opportunity exists because it's a pretty complicated business to understand. People don't take the time to dig into the segments to see what's actually in there. But in saying that, it can be a bit of a black box and that does scare investors. It scared me at first. So I think it's rightfully so that it does scare some investors. And it's hard to trust management from afar. So I get the reason this opportunity exists. So also I think that the value investing world as a whole kind of turn their noses up at anyone who is considered a new Berkshire Hathaway or the next Berkshire Hathaway. I get it. That it bothers me too. There's no going to be another Warren Buffett or Charlie Munger. And to compare anyone to Berkshire Hathaway is not fair. So when people start talking about, oh, they're the next Berkshire because they're a conglomerate doing similar kind of things, having good shareholder letters, having a good understanding of capital allocation, everyone just gets a little bit like, no, that's not true. And kind of gets pushed in the too hard basket because, no one's going to repeat what Berkshire Hathaway has done. So look, that's fair. I understand that, but I think that that's the reason why it's all getting overlooked. That's it for this whole series. And I really would love to get any questions and criticisms because I need to figure out why I shouldn't be investing in this one. I want someone to pull this apart on me, find any mistakes that I've made. Please, I really need your help on this one. I hope you can. Listen to Arch Capital's Chit Chat Money podcast episode as well. Then hit me up with your questions. I think between this and that, I think we cover most of the ground here. Very interested to hear what you think. Thanks for staying to the end of this little series. I hope you've enjoyed it, and I will see you in the next video.